As you peruse these words, understand that a prevailing narrative is flawed, not by intent, but by a disregard for statistical realities. While assurances of stability are being broadcast, precisely 14 key metrics are exhibiting critical alerts. These are the same indicators that signaled trouble preceding the economic downturn of 2008, the implosion of the dot-com bubble in 2000, and the historic collapse of 1929. Every one of these signals converges on a singular, unavoidable conclusion. A profound financial cataclysm is imminent. This is not a decade or a 5-year projection. Rather, the time frame is narrowed to a window of 12 to 24 months, spanning from the middle of 2026 to the latter part of 2027. The underlying mechanisms are already in motion. The timeline is constricting, and there is no force capable of preventing this unwinding, only delaying it. You possess approximately 18 months to prepare, 18 months to divest capital from precarious investments, 18 months to deleverage your financial obligations, and 18 months before the most significant redistribution of wealth since 2008 decimates the unprepared and rewards those who discern the recurring pattern early. This is not conjecture. It is not driven by fear. It is a consequence of mathematical certainty. Once the pattern, which has predictably repeated over the past century, becomes apparent, you will grasp why this impending collapse is not merely probable, but absolutely assured. Currently, the American economy stands at the precipice of the longest expansionary phase in contemporary history. The bull market that commenced in March of 2009 is now entering its 16th year. Historically, such cycles endure for 5 to 7 years. The preceding longest cycle, which concluded with the dot-com crash, lasted 10 years throughout the 1990s. The current expansion has surpassed that duration by more than 50%, exceeding the historical average by 6 years. However, economic contractions are not solely attributable to duration. They are precipitated by specific, quantifiable conditions that foster structural fragility. Every major financial collapse throughout history adheres to a consistent 4-stage progression. First, an era of excessive optimism and escalating asset values. Second, the emergence of warning signals that are systematically disregarded. Third, a precipitating event that exposes underlying vulnerabilities. And fourth, a cascading implosion driven by forced selling, creating a downward spiral. We are presently entrenched in stage 2, with warning indicators blaring, yet much like in 1929, 2000, and 2008, they are being overlooked by those in positions of influence. Historical precedent unequivocally substantiates this pattern. Consider 3 illustrative examples spanning nearly a century, demonstrating the immutable nature of this cycle. In 1929, the exuberant Roaring Twenties were in full swing. The stock market had surged by nearly 400% in less than a decade, propelled by transformative technologies such as the automobile, radio, and electricity. Optimism was pervasive. Individuals were enthusiastically investing in stocks, increasingly utilizing margin, which involved borrowing funds to magnify potential gains. Margin debt escalated to 12% of the gross domestic product, yet beneath this veneer of prosperity, warning signs were accumulating. Agricultural prices had been in decline since 1926, and consumer debt had reached unprecedented levels. The yield curve inverted in 1928, a reliable harbinger of recession. Florida's commercial real estate market had collapsed in 1926, following an immense speculative bubble, and bank lending had become increasingly risky. Economists, however, maintained that all was well. Irving Fisher, America's most esteemed economist, declared in September of 1929 that stock prices had attained a permanently high plateau. Just 1 month later, on October 24, 1929, marking Black Thursday, the market plummeted by 11% in a single trading day. By October 29th, Black Tuesday, the market had shed an additional 12%. Over the ensuing 3 years, the market continued its descent, and by July of 1932, the Dow Jones Industrial Average had fallen 89% from its peak. $30 billion in market capitalization vanished, 9,000 banks failed, and unemployment soared to 25%, while industrial production halved. The warning signs were evident, but they were dismissed by experts and ignored by investors, resulting in millions losing their entire fortunes due to the belief that this time was different. Fast forward to 2000. The dot-com boom had instilled in an entire generation the conviction that conventional economic principles no longer applied. The internet was perceived as a revolutionary force, and companies with no profitability were valued in the billions based solely on speculative potential. The Nasdaq index had surged by 400% in a mere 5 years, climbing from 1,000 in 1995 to over 5,000 by March of 2000. Day traders were abandoning their employment to pursue full-time stock trading. The prevailing sentiment was that this time was different, yet warning signals were abundant. The yield curve inverted in 2000, corporate debt reached record highs, and margin debt attained 2.7% of GDP, its highest level since 1929. Technology stocks traded at multiples exceeding 100 times earnings, and many companies possessed no earnings whatsoever. The Federal Reserve had raised interest rates from 4.75% to 6.5% by May of 2000. Wall Street analysts adamantly asserted that traditional valuation metrics were obsolete in the context of the new economy. Then, on March 10, 2000, the Nasdaq reached its zenith at 5,048. By October of 2002, it had plummeted by 78% to a mere 1,114, obliterating $5 trillion in market value. Retirement portfolios were halved, and hundreds of internet-based companies declared bankruptcy. The omens were apparent, yet they were discounted by experts, and millions suffered devastating financial losses because they subscribed to the notion that this time was different. Now to 2008. The housing boom had convinced Americans that real estate values were perpetually ascending. From 2000 to 2006, national home prices doubled, establishing real estate acquisition as the quintessential path to wealth. Increasingly, buyers were utilizing subprime mortgages, requiring no down payment, no income verification, and no demonstrable assets. This arrangement proved attractive to banks as they were not retaining the mortgages. Instead, they originated loans and promptly sold them to investment banks, who then bundled thousands of these loans into mortgage-backed securities. Every transaction generated fees. However, by 2006, warning signals were evident. Housing starts peaked and began to decline, and mortgage defaults started to rise in early 2007. The yield curve inverted in 2006, consumer debt reached record highs, and major financial institutions operated with leverage ratios as high as 30 to 1, meaning a mere 3% decline in asset value would erase all equity. Ben Bernanke, in 2007, claimed that subprime issues would be contained, and Treasury Secretary Hank Paulson declared the financial system sound. They were mistaken. Then, on September 15, 2008, Lehman Brothers declared bankruptcy. Credit markets seized up, and the S&P 500 index fell 57% from its peak to its trough. $11 trillion in household wealth was obliterated, unemployment surged to 10%, and nearly 9 million jobs were lost. The warning signs were present, yet they were disregarded by experts, and millions lost everything. 3 financial crises, spanning 3 different decades, yet the pattern remains identical. Excessive valuations, readily available credit, escalating debt, flashing warning indicators, and experts proclaiming that this time is different before the inevitable collapse. Now observe the present situation in December of 2025. The total valuation of the U.S. stock market approximates $60 trillion, while U.S. GDP stands at roughly $26 trillion. This yields a Buffett indicator of approximately 230%, significantly exceeding the historical average of 100%. In 2000, prior to the dot-com crash, this indicator peaked at 148%. In 2007, preceding the 2008 crisis, it reached 105%. Today's figure of 230% represents the most overvalued market ever recorded. The Shiller-Cape ratio currently stands near 39, compared to a historical average of 17. In December of 1999, before the dot-com collapse, this ratio peaked at 44. In October of 2007, Before the 2008 crisis, it reached 27. We are now at 39. Stocks are trading at more than double their historical fair value. Margin debt remains near historic highs at approximately $800 billion, constituting nearly 3% of GDP. There have been only 3 other instances where margin debt reached these levels: 1929, 2000, and 2007. Each of these preceded a massive market collapse. When stock prices decline, brokers issue margin calls, compelling investors to sell. This forced selling further depresses prices, triggering more margin calls and intensifying the downward spiral. Corporate debt has climbed to approximately $14 trillion, accounting for nearly 50% of GDP, a substantial increase from the historical average of around 35%. A considerable portion of today's corporate debt was issued between 2020 and 2021 at interest rates of 2 or 3%. This debt is now maturing and must be refinanced at rates of 5 to 6%, effectively doubling or tripling interest expenses. A company previously paying $60 million annually in interest will now face $180 million, an additional expense of $120 million, directly impacting earnings. Stock prices should consequently decline, but this adjustment has not yet occurred. Commercial real estate continues to deteriorate, with office vacancy rates persisting between 20 and 30%. Property values have depreciated by 40 to 60% from their peaks in 2021. A building valued at $200 million in 2021 might now be worth only $100 million, yet it carries a mortgage of $150 million, resulting in a $50 million deficit. Approximately $1.5 trillion in commercial real estate loans are scheduled to mature between now and 2027. Upon maturity, borrowers must either refinance or repay these loans. Banks are unlikely to refinance properties with negative equity, leading to defaults. These defaults will disproportionately affect regional banks, which remain precariously exposed despite the interventions of 2023. Between March and May of 2023, 3 major banks, Silicon Valley Bank, Signature Bank, and First Republic, collapsed. These failures were only averted through emergency lending by the Federal Reserve, but the underlying issues remain unresolved. Regional banks hold roughly $1.3 trillion in commercial real estate loans that are likely to default. As losses are realized, bank capital will be depleted, triggering further failures and bank runs, mirroring the events of 2008. Consumer debt has now surpassed $18 trillion. Credit card debt exceeds $1.2 trillion, with average interest rates approaching 22%. Auto loan debt stands above $1.6 trillion, and student loan debt remains around $1.77 trillion. Delinquencies are escalating across all these categories. Credit card delinquencies have risen from 2.1% in 2021 to over 3.2% by late 2025. When consumers are over-leveraged and delinquencies increase, lenders tighten credit availability and consumers reduce spending, both of which curtail economic activity and hasten a recession. The personal savings rate has plummeted from 16% during the COVID-19 stimulus period to approximately 4% by late 2025, far below the historical average of 9%. American households lack a financial safety net. When layoffs occur, they will have no reserves and will immediately fall behind on debt payments, default, and cease spending, thereby dramatically accelerating the recession. Unemployment has quietly climbed from 3.4% in early 2023 to around 4.5% by late 2025, a 1.1 percentage point increase. The SOM rule indicates that when unemployment rises by 0.5 percentage points from its low, a recession has begun. This threshold was crossed months ago, and the SOM rule, which has accurately predicted every recession since 1970 without false positives, suggests we are not merely heading towards a recession, but are already in its nascent stages. Manufacturing has been in a state of contraction for the majority of the past 2 years, with the ISM Manufacturing Index remaining below 50 for most months since early 2023. Manufacturing recessions typically precede broader economic downturns by 6 to 12 months, indicating that this recession is already underway. Leading economic indicators have declined for over 20 consecutive months through late 2025, marking the longest such sustained decline since 2007-2008. The leading economic index is designed to forecast recession 6 to 12 months in advance, and 20 consecutive months of decline strongly signals an impending recession. Yet markets remain near all-time highs. The Federal Reserve finds itself in a precarious position. After raising rates from 0 to 5.5%, they have reduced them to around 4.5% by late 2025. If they cut rates too aggressively, inflation will accelerate. Conversely, maintaining elevated rates will trigger the underlying recession. There is no scenario that avoids economic hardship. The Fed is managing the timing of the crash, not preventing it. Geopolitical risks remain elevated, with tensions between the US and China over Taiwan, the conflict in Ukraine, and ongoing Middle East conflicts all posing potential catalysts for a cascade through the financial system. In an over-leveraged system characterized by extreme valuations, any shock can serve as the trigger. The specific nature of the trigger is secondary. The system's inherent fragility is the primary concern. These 14 indicators are not predictions. They represent current conditions and quantifiable facts, and all 14 are simultaneously flashing red. Based on historical patterns, the timeline becomes clear. Through the first quarter of 2026, markets are expected to remain elevated, with optimism persisting despite mounting economic weakness. Corporate earnings are likely to miss expectations, and defaults in commercial real estate and corporate debt will rise. By the second quarter of 2026, financial stress will become palpable, and a trigger event, such as a major bankruptcy, a bank failure, a geopolitical shock, or a derivatives meltdown, is likely to occur. Credit markets will tighten, and stock prices will decline by 15 to 20%, initiating a phase of forced selling. By the third quarter of 2026, the cascade will accelerate. The S&P 500 is projected to fall an additional 20 to 25%, resulting in a total decline of 35 to 45% from its peak. Hedge funds will face collapse, retail investors will panic and sell, unemployment will spike towards 7%, and consumer spending will contract significantly. By the fourth quarter of 2026, the market is expected to reach its nadir. The S&P 500 is anticipated to fall to between 2,700 and 3,500, a decline of 50 to 60%. Trillions of dollars in wealth will be destroyed, unemployment will peak between 8 and 9%, and the Federal Reserve will have reduced interest rates to zero and reinstituted quantitative easing. The market correction will have run its course. In 2027, a gradual recovery will commence. Early investors who preserve their capital will achieve extraordinary returns, while the majority who disregarded warnings and sold near the bottom will never recover, their retirement plans irrevocably ruined. This is not a guess. It is a matter of mathematics. The S&P 500 is currently trading at 6,900. The historical average CAPE ratio is 17, and the current ratio is 39. For valuations to revert to the historical average, stock prices must decline by 56% from 6,900 to approximately 3,000. Valuations invariably revert to their mean. The Buffett indicator stands at 230% of GDP, far exceeding the historical average of 100%. For this indicator to return to its average, market capitalization must decrease by 57%, from roughly $60 trillion to $26 trillion. Corporate debt servicing costs are escalating dramatically as cheap debt is refinanced at triple the previous rates, representing hundreds of billions in additional annual interest expense, which will directly reduce earnings and consequently stock prices. Commercial real estate loans totaling $1.5 trillion mature over the next 24 months. Buildings are currently valued 40 to 60% below their loan amounts, leading to expected losses exceeding $600 billion. Banks will face insolvency or necessitate government bailouts. This is not speculation, it is basic arithmetic. The debt is real, the interest rates are real, and the losses are inevitable. The market downturn will commence within 12 to 18 months, with the bottom reached by late 2026, followed by a recovery beginning in early 2027. However, the damage inflicted upon the unprepared will be permanent. The distinction between those who are financially devastated and those who endure is not intelligence, but rather foresight and preparation, the ability to recognize the pattern before its completion. You have approximately 18 months. In January of 2008, the S&P 500 stood at 1,410. Savvy investors reduced their equity exposure, increased cash holdings, and allocated funds to treasuries and gold. By March of 2009, the market had bottomed at 680, a decline of 51%. Those who prepared in early 2008 preserved capital and were able to invest at the market's lowest point. Those who heeded the optimists lost half their wealth. If you had been informed in January of 2008 that a market collapse was 9 months away, would you have taken action? You are currently being informed that the downturn is 12 to 18 months away. The indicators are more transparent than they were in 2008, the valuations are more extreme, and the debt levels are higher. Act accordingly. The crash is coming with mathematical certainty. The same 14 indicators that predicted every market collapse since 1929 are simultaneously flashing red. The valuations are unsustainable, the debt is unpayable, and the system is over-leveraged. When it finally breaks, the unwinding will be swift, violent, and unforgiving. You have 18 months to prepare, 18 months to reduce risk, 18 months to build cash reserves, and 18 months to distinguish yourself from those who will be caught unprepared. The pattern is clear, the timeline is established, and the crash is inevitable. The sole question is whether you will be ready. If this analysis has illuminated the 14 warning signals flashing red, if you comprehend the mathematical impossibility of current valuations persisting, and if you recognize the historical pattern repeating itself, act now. You have 18 months remaining, and the window of opportunity is rapidly closing. This is not financial advice, but rather research data illustrating a pattern that has repeated for over a century and is currently manifesting once again. Understanding this pattern is the crucial first step toward navigating the impending event successfully.